For decades, retirees have been told to follow one simple rule, the 4% rule. It was sold as the gold standard for your retirement. But what if that rule, the one meant to give you peace of mind, is actually built on a foundation of fear? What if it's causing you to pinch pennies during your best years, leaving you haunted by what could have been? There's a retirement strategy out there that many finance professionals love to hate. It gets dismissed and called overly complicated. But the truth is, this strategy could be the key to a richer, more confident retirement, letting you safely spend more than you ever thought possible. So, if you're ready to ditch the outdated advice, let's talk about the most hated retirement strategy that actually works. Number 1, the 4% rule illusion. First, let's be clear about what we're up against. The 4% rule came about in 1994 from financial planner William Bengen. His research showed that if you took out 4% of your portfolio in your first year of retirement, then adjusted for inflation, you had a good chance of your money lasting 30 years. With a $1 million portfolio, you'd take out $40,000 in year one. Simple and easy. But the world has changed. A recent report from Morningstar warned that their latest projection for a safe withdrawal rate isn't 4% anymore. As of their latest report, it's 3.9%. That might not sound like a huge drop, but it's the difference between comfort and compromise. The real problem with the 4% rule, though, isn't just the number, it's the philosophy. It has serious flaws. First, it's completely inflexible. The rule assumes your spending is a flat line for 30 years, but life isn't a straight line. Retirees often go through active go-go years, slower slow-go years, and quiet no-go years. The 4% rule can force you to underspend when you're healthiest, right when you want to enjoy your freedom. Second, it's dangerously exposed to sequence of returns risk. This is the nightmare scenario of a market crash happening right after you retire. The rule was famously tested against the worst historical period to retire, 1966, and it just barely survived. Relying on a rigid rule that squeaked by during the worst of times is a nerve-wracking way to plan your future. Third, and this is the cruelest irony, the rule is often far too conservative. It's built to survive the absolute worst-case scenario. The result? Many people who stick to the 4% rule die with more money than they started with. This creates what I call the million-dollar ghost. You save $1 million only to be told you can live on less than $40,000 a year. You're a millionaire on paper, but you're living a life of scarcity, haunted by the money you were too scared to spend. Finally, the rule is based on outdated assumptions from the 1990s. We're living longer now, and it doesn't fully account for today's market conditions. Number 2, the hated solution, guardrails. So if the 4% rule is broken, what's the alternative? This brings us to a dynamic strategy called the guardrails approach, or the Guyton-Klinger method. It gets pushback because it isn't a single number. It requires you to stay engaged. Think of it like driving on a mountain road. The 4% rule is like setting your cruise control and just hoping you stay on the pavement. The guardrail strategy is about actively steering, letting you adjust your spending based on how your portfolio is actually doing. Here's the basic idea. Instead of a rigid 4%, you start with a higher withdrawal rate, say 5% or even 5.5%. Right away, you've given yourself a raise. But this freedom comes with rules, or guardrails, that keep you safe. There's the prosperity rule. If the market has a fantastic year and your withdrawal rate falls 20% below your initial rate, you give yourself a 10% raise for the next year. You get to enjoy the good times. But the real magic is the capital preservation rule. If the market has a bad year and your withdrawal rate jumps 20% higher than your initial rate, you take a 10% pay cut for the year. This is the part people hate, but this small, disciplined tweak is what makes the whole system work, allowing you to start with a much higher income in the first place. Number 3, the proof in practice. Let's make this real. Meet Michael and Jan, our hypothetical couple who just saved $1 million for retirement. Following the 4% rule, their advisor tells them they can take out $40,000 a year, locked in. It's a tight budget that keeps them from their dreams. They are classic million-dollar ghosts. Now, let's apply the guardrail strategy. Instead of 4%, they start with a 5.5% withdrawal rate. Their first-year income isn't $40,000, it's $55,000. That's over $1,000 more every single month, the difference between staying home and taking that dream trip to Italy. They set their guardrails. If their withdrawal rate falls below 4.4%, 20% below 5.5%, they'll give themselves a 10% raise. If it jumps above 6.6%, 20% above 5.5%, they'll take a 10% pay cut. In their first few years, the market does well, but year 3 is a monster, and the portfolio swells to $1.5 million. Suddenly, their withdrawal is only a 3.7% rate. It's fallen below their 4.4% lower guardrail, so the prosperity rule kicks in. They give themselves a 10% raise, boosting their income to $60,500. A few years later, the market hits a rough patch. Their portfolio drops to $950,000. Their $60,500 withdrawal is now a 6.8% rate, triggering the capital preservation rule. They take a 10% cut, reducing their withdrawals to $54,450 for that year. A pay cut is never fun, but notice their cut income is still thousands more than the $40,000 they would have been stuck with under the 4% rule. This small adjustment ensures their portfolio weathers the storm. Number 4. The ultimate hated power tool: annuities. What if you could make this strategy even safer? This brings us to the single most hated and misunderstood tool in retirement finance: the annuity. Annuities get a bad rap for high fees and confusing sales pitches, but at its core, a simple annuity does something no stock portfolio can: provide a guaranteed lifetime stream of income. It solves for longevity risk, the very real danger of outliving your money. Nobel Prize-winning economist Richard Thaler calls the resistance to them the annuity puzzle. The math shows that adding an annuity improves retirement, yet people don't want them. The ultimate strategy is to combine these two hated ideas. You use a portion of your savings to buy a simple, low-cost annuity to cover your essential expenses, your housing, utilities, and food. This creates a bulletproof income floor. With that peace of mind, you manage the rest of your portfolio with the flexible guardrail strategy. The annuity handles your needs, while the portfolio funds your wants, your travel, hobbies, and dreams. This hybrid approach offers the highest possible starting income with the lowest possible risk of failure. For too long, the retirement conversation has been dominated by fear: fear of running out of money, fear of market crashes, fear of the unknown. The 4% rule is a product of that fear, and it shrinks your retirement into a smaller life than you earned. By embracing the strategies others love to hate, dynamic guardrails, and a foundational annuity, you flip the script. You move from a place of fear to one of confidence and flexibility. You can give yourself a raise, share in the market's growth, and protect yourself from downturns, all while guaranteeing you'll never outlive your income. You stop being a million-dollar ghost and start living the life you actually saved for.